Last week, the Feds raised interest rates 0.75%, and it's very likely that another rate hike is coming as early as next month. Before we get all panicky, we're going to talk for just a few minutes here about the reasons for this and the implications on the economy as a whole, real estate in general, and real estate investing in particular. Now, this video is just going to be the highlights. I'll go into a bit more depth on the podcast, which I'll link down below. Speaking of which, and I've never said this before on any of our videos, but if you like this video, please click on the thumbs up, subscribe, hit that notification bell, and share with a friend. There. Now I feel like a real YouTuber. Okay, on the economy. What we have here by raising the interest rates, if you're not following this closely, it's an attempt to slow down inflation. Even if you're not following this closely, I'm pretty sure you're aware of the inflation. I mean, 12-pack of Diet Mountain Dew now costs $7 regular price. Well, I remember when you could get it for $2.25. Yeah. Anyway, prices are going up everywhere on everything. And it really comes down to the very basic laws of economics. There's too much demand and there's not enough supply. Why do we have not enough supply? Well, we've got COVID-related shortages, and we've got really dumb policy decisions at the governmental level. And I'm going to go into a few of those more on the podcast and have a little fun with that. But it is amazing to me how dumb our politicians can be sometimes. And they don't even think through, things like baby formula and energy costs and gasoline. Right. And then you have a demand in part created by an overabundance of cash. We had all of these free gifts, The government is just saying, hey, let's throw cash at the American people, and people have money to spend. Where are they going to put it? There's nothing to buy. So there is demand, but there's not supply. It's simple supply and demand mechanics at work. Now, is this going to work? Is it going to stop inflation? Eventually. And it probably will cause a recession. I'm predicting first quarter of 2023. This is going to tighten the money supply, which is going to move things the other way. And I don't know if we're going to see a real lowering of prices, but we're definitely going to see inflation eventually taper off. But I think that if history proves anything, the Feds are going to move a little bit too slow. They've been moving a little bit too slow to correct a problem that they caused. And then they're going to move a lot faster, and they're going to tighten it down too much because it's sort of, it trails the policy-making decisions. And then we're going to be in recession, I think, first quarter 2023, at least by the end of the first quarter. So what's going to happen? Mortgage rates are going to rise. And I'm predicting this is going to be 6 to 7% at the end of the year. Now, I know that I said the same thing back in 2020. I was a little smarter in 2021. But I thought they can't keep the zero interest rates forever. And so I just kind of assumed that they were going to edge up interest rates back in 2020, and we would begin to see an increase in mortgage rates. Now, that didn't happen because of the pandemic, so I get that. But now there's no choice. As the Feds inch up the prime borrowing rate, mortgage rates are going to go up. They're already up over 5. They're already up almost 3 points more than they were just at the start of this year. And I think they're going to go up another point or two by the end of the year. Still low by comparison with history. So what happens? With higher rates, people can afford less. So there is an increased demand for lower priced home, and people have a little bit less buying power, so the more expensive homes are going to sit there a little bit longer. Then when you add in the fact that foreclosures are going to come back in a pretty powerful way in the third quarter, just a few months from now, we're going to start seeing a marked increase in the number of foreclosures. I've been calling it a bump. I've been predicting for a year or more that we're going to see a bump in the third quarter of 2022 and maybe into the fourth quarter. We're going to be kind of catching up with a lot of those people that have had deferments working through the pandemic. So we're going to start to see in the housing industry supply catching up with demand, which is going to begin to slow the rate of price increases. I'm not saying it's going to be a bust. I'm not saying that prices are going to fall out. However, there is a bit of disturbing news on the horizon, a proposed policy that if it's put into effect, it will create another meltdown like we had in 2008, and that'll be probably 2 years out. I'll say more about that if this policy gets approved and actually passes through the almost sure constitutional challenges. I'll get into that later on. But for now, we're going to see a cooling off in the real estate market. Prices are going to be lower and rates higher. So if you're a borrower, your buying power actually won't change all that much because prices are not going to continue to climb. And yeah, you'll be able to buy less, but the home you want is probably going to cost a little less. Okay? So all of that is just about the economy and housing in general. Real estate investors. You know, when the crash of 2007 and 8 first hit, it hurt a lot of us investors, and it hurt me. But somewhere around the end of 2008, I figured out how to make money in that economy and did very well between 2008 and 2012. Very well. And that's probably an understatement. So as much as we don't sit around rooting for bad economic times tend to help our business if you're prepared and if you know what to watch for and if you know what to do. Now, it's been 6 years since we've seen a balanced market in real estate. A balanced market is one where there's about a 3-month supply of houses on hand. It's been a long time since we've had that. I think we'll have that again by the end of this year. The rising rates are going to slow down the buying frenzy, which will decrease demand, increase supply, and force price competition among sellers. Adjustable rate mortgages will take some borrowers out of the ability to pay for their home. Now, that's not going to be like it was in 2008 because we don't have the same ARMs that we did back then. But you're going to see over the next few months a lot of pre-foreclosure opportunities arising in your area. Available inventory is going to increase with slowing sales everywhere. Because of slowing sales, investors are going to start to back away from smaller cities and towns. I'm already, thinking ahead 6 or 8 months. Those of you that follow me know that I've been investing in a lot of small towns across the Southeast over the past few years. And that's going to come to an end as the market gets to back to more of a normal thing. Well, what this means for you as a real estate investor, it means more inventory, better deals, faster progress, higher profits, a few more challenges on the selling side. You're going to need to buy aggressively so you can sell aggressively. Why? Because you need to keep the money moving. As soon as I thought that phrase, buy aggressively so you can sell aggressively, I thought, well, why not buy passively so you can sell passively? The key to this, to real success and progress in your wealth development is keeping the money moving. Okay? Now, I've already said I think I see a recession coming around the first quarter of 2023 and higher interest rates, of course. And I believe that it is too late to see any impact from these decisions on inflation, any meaningful impact in this calendar year in 2022. Now, just a reminder, I'll go into a lot more depth on the podcast. I wanted to keep this video relatively brief, and mainly I wanted to encourage you, do not panic. Opportunities are out there. No matter what's going on in the economy, there's no such thing really as bad news. There's just news. All of the economic news is bad for someone and good for someone else. What you want to learn how to do is to sort out where the opportunities are, no matter what the news is, and learn to look 6 to 8 months ahead so you can anticipate what's about to happen. What you should be doing right now is stacking up a little bit of cash from your flips because opportunities are on the way.